Facebook has very elaborate tax disclosures. They disclose both their foreign and domestic taxes. As you see, they have much more income in the US as compared to elsewhere. From a tax perspective, they pay much more to Uncle Sam than elsewhere. $6,094 million of taxes at the US federal level, $874 at the state level, and $1,928 of foreign taxes. Their total taxes paid is $8,996. But how much of this is the current tax expense? You see that number is $5,619 million. So they have an expense of $5.6 billion, but they end up paying $8.9 billion. And they register a deferred tax benefit or a deferred tax asset of $3,277. This means that in the future, they will pay less taxes of $3.2 billion. Companies are clever and simply try to get as much beneficial treatment to reduce their effective tax rate. In the case of Facebook, they lower their tax rate of 21% by 2.4 percentage points because they do a lot of R&D. They also lower their taxes by another net of 4%, calculated as a minus 7% and a plus of 3%, because they have negotiated favorable tax deals with governments abroad. As you see, Facebook has an effective tax rate of 12.2%, 16.7%, and 19.5% over the last 3 years, because they have managed to cleverly use all sorts of incentives and deductions. Why does Facebook have so many operations under deferred tax assets? Well, all companies have this. Sometimes they pay taxes earlier, sometimes later, as compared to their tax expense on the income statement. This slide is easy to understand. Let me make a few examples. Accrued expenses leads to a deferred tax asset of $1,627. What does this mean? This means that Meta has paid more taxes by $1,627 because the government has not accepted the deduction for accrued expenses. What are accrued expenses? These are expenses where the expense has been recorded, but cash has not been paid. It is obvious that this will not lead to a tax deduction. I showed you the earlier example where unpaid wages expense led to a deferred tax asset. This is the same. You have unpaid expenses. These do not lead to a deduction on the tax filing. How about unrealized losses in securities and investments? Why does this lead to a DTA? The answer is simple. Some of your investments have lost value. This is put as an expense on the income statement. However, there were no cash losses, so the government does not accept deduction, and you have to pay the taxes anyway. Why does depreciation and amortization lead to a tax liability of $6,296? Well, it is obvious that the government is depreciating assets at a faster rate than that done for financial reporting. You are getting extra deductions today, so you are paying less taxes today. However, you are going to pay more taxes in the future, so you have a deferred tax liability. The net balance of deferred tax asset and liability is $4.946 million of net tax assets. The change in net deferred tax assets is $3,217, which is very similar to the number we had on slide 11. Please remember that on the cash flow statement, if you have more assets, then you have less cash. Here we have higher deferred tax assets of $3,286 billion, which is deducted from the cash flow statement, which means that our cash is less. This makes sense. We paid $3.286 billion more of cash taxes than our tax expense. Hence, we have less cash by that amount. Remember, taxes are important. Taxes make society function. People need to pay their taxes. That doesn't mean you need to pay your taxes yourself. You should pay as little as possible, and hopefully you let everyone else pay and you enjoy all the benefits of their effort. Okay?